In this video, traders, we'll look at short squeezes. Stay tuned. Hey traders, a warm welcome to you. All right, so while I'm filming this is a brutal short squeeze right underway with a company called Beyond Meat. Recent IPO, ripping higher. We'll go to the screens in a moment and look at it, and it looks very similar to a very recent actually IPO for Tilray. I say recent, a couple of months ago, but same kind of thing. So what I want to do is I want to look at the anatomy of it. I want to look at kind of some of the chart patterns, some of the things. The main thing is we need to, if we're going to get involved in this, and actually, you know what, we don't need to get involved in this, there's plenty of opportunity there, but if it's this kind of thing that fits your level of risk tolerance, the number one thing is to stay alive in it, because many people are trying to get short on this, many people are trying to trade this and are getting their faces ripped clean off. So we don't want to get our face ripped clean off. We want to, if we're going to get involved in it, be very careful and very calculated and be prepared to miss it rather than actually diving in and getting hammered. So let's go to screens and let's look at Tilray first, then let's look at Beyond Meat. Okay, so Tilray, guys, IPO came out, we were trading around, whatever this is, 20 bucks, 25 bucks. It took a while actually, it took a couple of months, and it just started really going. It doubled, and people thinking, oh, in fact, I zoom in a little bit, it doubled, people thinking, oh, you know, that's $40 now, it's doubled from IPO. Then it trebled, and it quadrupled, and all of a sudden this is when the real short squeeze is happening, right? We get this move here now, guys, is really just people punting away on this. This is irrelevant. The fundamentals are now irrelevant. Everything else is irrelevant. It's pure supply and demand. And now listen, even if you don't want to trade it, which I understand because these things are crazy, you can learn stuff from it. So let's go back and have a little look. Then now we start gapping up, and the way you can tell this thing is not going to die yet, or clues, you never know, do you, for sure, but clues is not going to die. Let's minimize these ticks, that's from my Dow, is how it responds on lower gaps. So you're getting gap up, green, gap up, green, gap up, green, gap up, still closing. So multiple gaps up, even if filling gap intraday, it's still closing higher. Gap lower is bought. And then this is the real key thing, guys, is this little area here. You know, pull back. If pullbacks are bought, we pull back, it was bought. We gap lower, pull back, it was bought. The next day, when it gapped up, that was it. That was it. Shorts were like, they had enough. They'd probably been in since here, around here. They'd probably sold into this first move lower, which is rule number one, guys. You don't sell into the first move lower on these things. The first move lower catches the amateurs out because it goes another leg, squeezes there and does a double squeeze. So you never sell the first kind of pullback off the short, no matter how high it goes. Go up 1,000%. First pullback, you leave it. Let it go and let it see what happens on the next. More than likely, it'll rip to highs. Now, is that a long opportunity? Potentially is. When everyone's looking for the short, potentially it's a long opportunity. However, you've got to be so careful with these. Holding overnight, deadly as anything. Intraday still can be deadly because they can be halted. Super risky. But on the front side of the move, it's long or out. You know, don't try and think about the valuation. Twitter will be going crazy about how overvalued this thing is. People will be going short. They will be getting their faces ripped off. We don't want to get our faces ripped off. As we said, golden rule, don't get your face ripped off. Let's go back to the screen. So first pullback, we're not getting involved in it. Second pullback, we're watching, but again, we want to be patient. There's so much opportunity in it. We don't need to be the Mr. Clever who gets it at highs. Then this is really brutal for the shorts because they've been in this, probably been selling into this, which is why we got their first kind of decent pullback after the extended move. Putting lower. Now they're holding on. They get a bit of hope with this because it comes back to nearly their entry at this point. But then, of course, we get a move up, and the next day when it gaps above the high, so many people have got their stops there, so many people are coming into it, get that massive supply demand imbalance, and then after the next day we'll just get crazy. You know, we move up to 300 and we're down to kind of 150, so it's halving the value of the stock intraday. This is pure chaos, volatility and chaos. If you want to steer clear of it, I don't blame you one bit. We're about capital preservation first, guys. There's a lot of people gambling in this stock. The real high probability stuff comes, generally speaking, and listen, there are people who are professional traders who are taking advantage of stuff like this, and that's fine. There's opportunity there, but most of the time there's plenty of opportunity to come after all the crowd has been punting away, losing millions, making millions, whatever it may be, and the calms down a bit and the more high probability move comes into play. So once we've got that, we want to see what's going on. And move off the high, there's our literal exhaustion, just to show that the full exhaustion on here, the real, and actually, you know what, let's put some volume on here as well to to kind of model things a bit better. And we can just see the really extreme volume on this, guys. Really extreme. Comes back off the high. Now, very tempting to trade off this backside, and that's fine. I think that's okay. When you've seen a big reversal intraday, the next day, i.e. this candle, I think you're okay to be playing on the short side if you can find some stock to borrow. You might not be able to find stock to borrow, of course. I think that's fine, but again, be careful because it's not normally dead like that. There's normally a lot of people still trapped in it, a lot of buyers waiting to buy for whatever reason. So you've got to be very careful. And then, of course, we get this second leg up, which again, you know, it's gone from like 90 to 160, 180, big short squeeze. But when we don't get new highs, this here to me is where the kind of opportunity lies. Okay, it's after you've had the extreme move, after you've had the pullbacks, after the brutal stuff, after it's posted to a new high, but it's kind of faked out a little bit like this, that kind of level, and rejected aggressively. That's when opportunity comes in, this kind of area for opportunity. And then perhaps subsequently, you know, when it just dies lower and lower, when the hype dies off it and you know that actually the likelihood is it's going to revert back at least to close to the IPO, maybe double the IPO or even triple the IPO. But even that, think about the IPO, right? The IPO is a vote of institutional investors, especially the open, forget about the IPO price, the open maybe, investors, what was the valuation of this? So even if you treble the valuation, go right, $60 is the mean for this. There's still a long way to go. And sure enough, look, we came back to actually $60 here, and we've kind of drifted lower, and we've drifted back, and we've kind of settled at double the price of the open, which makes a bit more sense. Frothy, but we're not talking 300 here. So it's being careful about that. And very quickly, guys, look at Beyond Meat, which is one that's going now, and how the similarities are with Beyond Meat. So Beyond Meat, same kind of thing. You know, IPO down here, 40, we've doubled, tripled, and now we're getting that gap higher. That's the proper short squeeze from there for 100 to 180. Bang, the pullback. Remember, never do the first one, never ever do the first pullback. Here's the first pullback because the second one rips up. Now we're at the top of this. Now let's see what happens. We know from Tilray there's been one more pulse, but the kind of meat or the froth comes after the juice is all gone, all the gamblers are out of it, and it might then retrace back to, let's say, double IPO, triple IPO is 150, so it's not as aggressive as the Tilray one, but say double IPO, a double open price on the IPO day. If you go 90 to $100, that would be your kind of move to look for. But, you know, this could rip again. This could even just be getting started. So you could be so careful with risk management with these guys, because they are very aggressive. They move intraday, and if you've got any discipline issues about taking stops intraday or not pulling the trigger, these aren't to be traded. And listen, there's no harm. Money's money. Doesn't matter if you've made it in the most quietest, calmest thing ever. When you go to the bank, they don't care where it come from, guys. They don't care if it asks if it came from Beyond Meat, Tilray, or US Steel, or Vodafone. They don't care, right? That's the way it works. So if you don't trading it, it's worth looking at just for interest. You go on TradingView, one of the other things, you can get the chart for free, and you can kind of just watch it and just look at it and see how there's a good lesson in supply and demand. And it'll be interesting to see, is this second wave up enough to get the last of the shorts out? It's definitely a big red candle off the highs. Will it gap lower now? Let's have a look and see what it's scheduled to open at. It's scheduled to open, up about 1%, so flat pretty much for something like this. But this will be interesting to see. If it fails again at highs and rolls back, maybe that's it. Maybe then the shorts have got a bit of a handle on it, they've got a bit of grip on it, they're not going to be frightened out anymore, because shorts act in two ways, guys. They are the ones that are fueling the upside, of course, when they're stuck short, because they're expected to treble on them, and so they're the ones buying at highs, being margined out. And also there's a high cost to borrow. You know, a lot of spread bettors won't allow you to short this, unfortunately. And if you can borrow stock, you're paying a very expensive borrowing charge as well, because it's very popular to be shorted. So it's just lots of different dynamics going on. People getting hurt, people coming in with greed, just watching how supply and demand works. So well worth watching, guys, is Beyond Meat. And again, look up Tilray and kind of look for yourself and see how these little short squeezes in individual stocks, specifically after IPO, work. And it's a good lesson, even if you don't trade these, you trade Forex, you trade indices, you trade commodities, of how supply and demand works, how things kind of move when there's really money flowing in and out of it. All right, guys, take care and see you in the next one. Bye-bye.